You've mentioned the falling dollar. I believe the DXY index fell like 10 points in the past year. Where do you see the Dixie end of this year, and where could be the bottom? Is it likely other central banks will allow the US fall much further against their currencies?
Well, that's part of the reason why we had a counter rally in 2021 because we have had some foreign central banks have been more aggressive at holding their rates, at a lower level to try to offset the fact that their currencies were strengthening against the dollar. At the grand scheme of things, it's very hard for other countries to kind of permanently do that because basically the United States has structural trade deficits. And so when we're running the biggest fiscal deficits and we have big trade deficits, and when the Federal Reserve's buying a lot of the fiscal debt, that tends to be pretty bearish for the dollar because those other countries have strong current account surpluses that help prop up their currencies, and so it's actually pretty challenging to weaken them as fast as the dollar in those environments. Now there could be periods of time where you have that counter rally. My overall base case is that I don't think this dollar decline is fully done yet. I think we'll see lower lows before we see higher highs. But I don't know the exact timeline of that. It's something I'm monitoring quarter to quarter. And so I think that that if you look at, say, quote unquote fair value of the dollar, meaning that it has a balanced trade situation, that could be a dollar index below 80. However, the question is if it's going to get anywhere near fair value anytime soon, or if these imbalances will continue for a period of time. And so my base case is that we'll see lower lows before lower highs, but I'm kind of watching that play out rather than making specific 6 month or 12 month predictions. Just that my overall base case is that we still are in a bear market.
In the 3 to 5 year time horizon, do you still see the dollar falling?
That's kind of I think the 3+ year timeline is where I see the dollar kind of having that structural decline. If you
Mhm.
look back over the past 50 years, like I said, we've had these three really strong dollar bull markets, and then two of them of course ended in very sharp dollar bear markets. And so my base case is that we're currently in the third dollar bear market. And you basically, in some ways, we've been in a dollar bear market since 2016, although it's been kind of a flat to sideways bear market. Another way of looking at it is that we, ever since, kind of the peak, like the crisis peak in 2020, that kind of March April period, we've been in a dollar bear market since then, and so that's kind of how I'm monitoring. And I do think that this could be a 3 to 5 year process playing out, but it's not a sure thing. It's something that I'm monitoring, and of course, there's always things like vaccine differentials or the potential for conflict of some sort, like some sort of between the United States and China, for example. There's all these curveballs to watch out for, but overall, my base case would be a lower dollar 3 to 5 years from now than it is today.
How have the expansionary policies and the falling dollar been affecting commodity markets? What can we expect in the years to come? Grain prices have reached new 3 year high. Iron ore is breaking records as well. Are these commodity markets moves in line with the targeted CPI, or are they indicating something more?
Well, so it's kind of a complicated question because you have to go back a little bit in history. So the short end of it is that a weaker dollar should be good for commodities and for emerging markets, but that relationship can be somewhat tricky, and so in many ways commodities have been in a bear market since 2008, and of course different that's like the broad commodity index, and then you can also break that up and of course isolate different commodities. So some of them are not in a bear market. I mean, beef, lumber, those have reached all new all-time highs, whereas many of them have not. And so, for example, energy is one of the the worst areas that's been in a bear market since 2008. One of its deepest bear markets in history. Whereas other ones like say copper's done very well, but it still hasn't cleared previous all-time highs. Same with many grains; they've done very very well, but they're not at peak all-time highs from years ago. And so that's it. Basically, the last 10 years or so have been an environment of, pretty strong dollar, pretty sluggish global growth. We had a very strong commodity, bull run in the 2000s decade, and so we cooled off and consolidated for the 2010s decade. So my base case is that the 2020s will see a weaker dollar and we'll see a stronger commodity market, but that won't be in a straight line. And so I do think that commodities are likely to break out of this, 10-year, more than 10-year bear market that many of them have been in, but not necessarily every single one. So, for example, I could see lumber cooling off while energy picks back up. But of course, in the broad commodity, basket, energy has a bigger, role to play than lumber for the most part. And so I watch things like capex cycles, right? So it's not just about demand for the commodity; it's also about supply of the commodity. And so periods of low demand eventually generally lead to lower kind of capex to bring new supply online. And that's actually one reason why the 2010s were so bad for energy because you kind of didn't see that relationship. Even though commodity prices were low, the United States kept bringing on more and more shale energy, and most of it wasn't profitable. They just kind of, they lit their money on fire. They basically, they paid, $60 a barrel to get, oil at $50 a barrel out of the ground. And so, but investor appetite for that has somewhat weakened, right? And then combined with ESG mandates, and so you have some pension funds around the world or sovereign wealth funds around the world saying that they're not going to invest in energy anymore. And so many of those companies are forced to be profitable. They can only, drill for new oil out of profits they made from drilling oil. And so they're more kind of selective with the types of projects they do. And so I do think that the 2020s could have this, we could put this period of oversupply behind us and potentially enter a period of tighter supply, and of course, that depends on things like other strains of the pandemic, China's economic performance, of course, because they're such a big consumer of energy now. So there's a couple of variables that could throw that off. My base case is that with relatively tight supply and improving demand, that commodities in general will probably have a pretty good decade.
Is energy sector or especially crude oil a good inflation hedge right now?
Well, almost by definition, it's a good inflation hedge because a lot of consumer price inflation is tied to energy. And so over the past decade, we've been in an environment where we've had two very different types of inflation depending on what your expenses are. And so, for example, we've had inflation in healthcare costs, especially in the United States. We've had inflation in childcare costs. We've had inflation in tuition costs. However, goods have been very cheap and commodities have been very cheap. And so, for example, because energy prices are so low, that's allowed a lot of consumer prices to go down. And because of improvements in technology and automation and offshoring, things like consumer electronics have been very cheap. And so we've had deflation in some categories and inflation in others. Now, if you were to get that tighter energy market, that can potentially have those things that have gotten very cheap start to push back up. You can have it's more expensive to ship things. It's more expensive to make things because of course energy is an additive to a lot of the products we use, and so that overall could contribute to higher prices. And so I would expect that that oil would be tightly correlated, to consumer price inflation. In addition, we have the electric vehicles coming and potentially taking some market share from oil. But if you look at natural gas, I mean that's largely used for heating and electricity production. We also have natural gas liquids, which are used for additives in multiple products we use. I mean, the computers that we're using to do this interview with, and all the little plastics and parts of that around the computer, for example, are derived from oil and gas ultimately. And so I do think that demand for those will still be pretty persistent in the 2020s, and that could be a component in higher consumer price inflation that we've been accustomed to over the past 10 years.